the press release, so I'll give a quick overview and pick out just some of the key points that I see in them. Clearly, 2015 was a tumultuous year. Volatility and uncertainty were pervasive throughout the year. World trade dipped ominously in the first half of the year before rebounding in the second half. Oil prices plunged more than 60%. The US dollar appreciated around 20%. China's economy slowed but bounced back somewhat by the end of the year. And on a more positive note, import demand strengthened appreciably in the EU and the United States, cushioning somewhat the slowdowns elsewhere. So the overall result was growth of 2.8%, making 2015 another year of weak but positive expansion in global trade. Turning to 2016, we're predicting that trade growth will remain constant at 2.8%. On this basis, 2016 will be the fifth consecutive year of sub-3% growth. And while this is clearly a disappointing picture, it is not unprecedented. In fact, trade growth was weaker in the early 1980s, and we expect to come out of this pattern of low growth in the coming years. For 2017, we're forecasting that trade will pick up to 3.6% growth. These numbers are premised on world GDP growth of 2.4% this year and 2.7% next year. So, of course, risks on these forecasts remain mostly on the downside, such as from further slowing of emerging economies, volatility in financial markets. Indicators of business and consumer sentiment have turned more negative recently. However, there is also some limited scope for upside potential if monetary policy, which is already in place, succeeds in lifting the euro area. So that's the overall picture, but there are a few points that I would like to draw your attention to. So first, it is very important to note that the distinction between trade growth in dollar terms and in volume terms. So, press reports of collapsing trade last year mostly referred to the dollar value of trade, which was down by a striking 13.5%. The disruption caused by the declines in the dollar value of trade is very significant, of course. In 2015, so last year, this was mostly attributable to big movements in commodity prices and in exchange rates, not a decline in the number of goods that were moving across borders. So that is a very important point. So a decline in trade volumes would usually be associated with global recessions. So that's why we place more focus and attention on trade volumes than in trade values. Second, so that's another point I'd like to stress, while we expect growth in volume terms to remain fairly constant, the composition of trade growth is evolving. So that is an important point as well. For example, a key driver of growth from 2011 to 2013 was import demand in Asia. Now, in the last 2 years, this has shifted. Demand in the United States and in Europe is driving the modest growth that we are seeing today, making up for the slowdowns in Asia and elsewhere, of course. So in fact, if Asia's contribution to trade had matched its average of the recent years, world trade would have grown in 2015 3.5% instead of 2.8%. So the slowdown in Asia contributed to the numbers that we see before us significantly. So although the slow growth in trade today is reminiscent of the early 1980s, the situation is also very different in some key respects. Global trade has been transformed over the intervening decades with a far wider range of major players now influencing and impacting on the growth that we are seeing. For example, in the 1980s, developed economies accounted for more than 70% of world imports, but this has fallen since to 57%, so from 70% to 57% since 1980s. Meanwhile, the import demand in Brazil, China, and India rose from less than 3% to around 14%. So that's a very significant change in the role of the drivers of imports and of trade globally. A third point that I would like to make has to do with the evolving relationship between trade growth and GDP growth. Now, according to our forecast, 2016 will be the fifth year that world trade will have grown at roughly the same rate as world GDP, so about 1 to 1, right? Instead of 2 to 1, which was the norm in the years before the financial crisis. So this contrast is, of course, striking, but it is not very illuminating. The sluggish growth we are seeing today is atypical, of course. 1 to 1 ratio is very low, but the 2 to 1 ratio before the crisis was also atypical. Now, we should not be expecting a return to that kind of very high atypical growth in the near future. The post-war average for trade growth to GDP growth is actually around 1.5 to 1. So that's the average, that's the historic average. And we think that a return to this level is more realistic in the medium term. So finally, and that's the last point, I would like to underline again that the WTO members have the power to influence this situation. There are a number of steps that we can take to ensure that trade lifts economic growth, job creation, and development. For example, WTO members can roll back trade restrictive measures that they have put in place since the crisis, and that they can act also on the significant agreements which members have struck in recent times. That's the case of the Trade Facilitation Agreement, which will cut global trade costs by up to 15%. So this is a bigger impact than eliminating every remaining tariff around the world, and it could deliver a $1 trillion boost for global trade. So we're seeing excellent momentum in ratification of the Trade Facilitation Agreement, so it has picked up considerably recently, but we need to complete this task as soon as possible so that the benefits of this agreement can be reaped. Similarly, members are taking positive steps to follow through our other decisions, such as the deals that we struck in Nairobi in last December, to scrap farm export subsidies and to eliminate tariffs on a wide range of information technology products. Of course, we can do more. Members are having a robust debate right now on the potential path forward for our negotiating work, looking at how we can tackle the remaining Doha issues and potentially discuss other non-Doha issues as well. Since Nairobi, I have reached out to members to facilitate this discussion. I have visited more than a dozen countries in recent weeks and met with leaders from around the world. The level of interest in our activities here is surpassing anything that I have seen before. So I'm optimistic about our future work and its potential to foster economic growth and job creation. So that's what I had as introductory remarks. I will take about 3 questions if you want to raise them. And then I have to leave, and I'll leave Bob and Coleman to take up the rest.
First question to Tom Miles, followed by Jean-Pierre.
Thanks very much. Sorry. It seems to me that the 2 major risks for the developing world at the moment are not covered in this report, or 2 of the big risks, namely the outcome of the US election and the Brexit referendum. Maybe I'll leave the US referendum to your September press conference, and I'll ask you about it then if I get the chance. But Brexit is, looming in the next few months, and I wonder what you think is the risk of that significantly complicating trade relationships. Thanks very much.
I have no problems approaching both. As far as the U.S. elections, if you are referring to what candidates are saying, I cannot comment on candidates' statements. Candidates can say anything. Officials cannot do anything. So we have to see what becomes of U.S. trade policy once the change of government is effected. We have to wait that before we can comment on anything regarding particular positions that have been taken during the electoral process. On Brexit, clearly, number one, this is a very important decision, a very critical decision that has to be taken by the British people. So, number one, it's their sovereign right to decide whatever they want to decide. Number two, it is clear that trade is a very important component of the British economy. The UK has always relied on trade, both in goods and services, as an important component of their economic mix, and therefore leaving the EU will have an important trade component, clearly. How that will affect not only the UK's economy, but other relations with the EU and other countries, that's at this point in time would be completely absolute speculation. It depends on the terms of if it does happen. It depends on those terms of separation. It depends on the relationship that will ensue between the EU and the UK. It depends on negotiations that the UK would have with WTO members to clarify what the rights and obligations would be at that point in time. So this is something that should be looked into very carefully. And again, this is a sovereign decision of the UK, and I will withhold my comments at this point to what I have said so far.
Jean-Pierre.
Jean-Pierre Kapp, Neue Zürcher Zeitung. I would just like to know, as far as I'm aware, there's no indications for the recovery you expect for 2017, or what is it based on?
Well, usually our always our trade forecasts are based on economic GDP growth forecasts. The number for that we are using for the GDP growth for next year, 2017, is
2.7%, I believe. It's 2.7.
2.7%.
From 2.4.
Up from 2.4, so 2.7% of GDP growth. So we're basing our forecast for next year on that. We are expecting a ratio that is slightly higher than what we have today. Today we're around 1.1. We're expecting something a bit larger than that. Again, like I said, forecasts depend a lot on expectations materializing. We hope that, for example, one potential up would be if the monetary policy in the EU, which lags after a while, so it has been implemented, the expansionary measures have been put in place. We have a lag between the moment when they are introduced and the economic impact, the real economic impact. So that is something that could help for next year. And let's see what happens in Asia. If Asia picks up to where they were before, if it were not for the second quarter of last year, we might have seen very different numbers this year. So hopefully if Asia also picks up next year, we will be better positioned. So 2017 may look brighter.
Jamil Chada, please.
Mr. Azevêdo, Jamil Chada, São Paulo. My question is on the situation in Brazil. Two questions. You mentioned that it did affect South America in terms of imports, at least at the, I would say, the average. My question is how much? Is it still bugged? No. Sorry for that. Yeah. So my question was on Brazil. Basically, how much does the situation in Brazil affect the region, South America? And what would be your advice at this moment in terms of trade policy regarding Brazil? Thank you. In light of the crisis, of course.
Well, in terms of trade numbers, clearly when the economy slows down, and Brazil's economy slowed down considerably, in fact it's in a recession, one very clear indicator is the diminution, the contraction of imports. So Brazilian imports have fallen significantly, so that's not surprising given the economic situation. As to the precise impact that would have for the Latin American numbers, I don't know. I will ask Bob and Coleman to pick up on that. Yeah.
Sure. Brazil's share in South America's imports is around 25%. I can confirm the figure later, but it's the largest market in South America. So how Brazilian demand goes will have a strong influence on the region overall. And I can provide the precise figures afterwards.
I'll now take the Director General to his next appointment. Bob and Coleman will stay and continue with your discussion.
What was the second
sorry.
part of the question?
What would it be your advice in terms of trade policy in Brazil in light of a contraction in imports and exports? If there's anything that could, let's say, enhance exports at this moment or not, despite the crisis? For example, reduction of trade barriers, etc.
Well, I don't get paid to give advice to any country, unfortunately. No, what I can say is that trade policy in general is an important mix for economic development. It's an important element in the mix. So Brazil is no exception right there. And I have said before that the overall shape of the economy has a bearing here, and the economy at this point in time is not growing. Therefore, trade policy needs to be considered carefully, because while many countries have pretty much exhausted their capacity to influence growth by means of monetary policy or fiscal policy, trade policy has not, at this point in time, been used to its fullest. So clearly, for example, the agreement on trade facilitation, so measures that lower costs, that facilitate trade, can clearly be a boost in the economic situation of any country, because exports clearly will pick up, and the productive matrix will operate in a more efficient way.
Thank you very much. Joseph, would you take over the press conference for me? Thank you.
Good morning, everybody. So Coleman and I are here to take, I guess, your more technical questions. We'll stay away from the political ones. And I would like to acknowledge our statistics team sitting back there who have helped Coleman and I be a lot smarter than we otherwise would be. A couple of comments to follow up on the DG's presentation. One thing to keep in mind, that while trade growth has been relatively weak, the DG mentioned that the geographic composition, in a sense, of trade has changed dramatically since the 1980s, and we see much more integration of emerging markets and developing countries into global trade. It used to be relatively easy up until the 1980s. All you needed to do really was look at what was happening in the US and EU, and that would explain 70% of global trade. And now we have a lot more players in the global trade marketplace. The good news is the emergence of these developing economies and emerging markets, they still, even though they've had relatively weak growth, their volume of trade still remains growing faster than the volume of trade for developed countries. So again, emerging markets and developing countries are very active participants in trade, and we see this as a very positive development. What it does mean, though, for 2017 is many of the projections for GDP next year see relatively weak growth in Latin America in particular, and in a region that is an agglomeration of other countries that we call other. So when you look at our forecast for 2017, which is faster trade growth than what we have in 2016, we see that region as being relatively weak, Latin America. So that is of great concern to us, and we'd like to see a turnaround there. The US and EU are pretty much steady contributors to trade expansion next year, and we expect the recovery in Asia that occurred in the last 2 quarters of 2015 and continuing so far this year to continue in 2017. So keep in mind our forecasts do depend on forecasts of GDP growth, and that we see this increased participation in global trade, so more countries' GDP growth matters for what happens in trade, and that next year we are expecting steady growth in Europe and the US, this continued steady, recovered and steady pace in Asia, and then weak growth in Latin America and elsewhere. I'll close there. I don't know if Coleman, you have a comment that you want to add to that, and then we'll take questions. Thank you.
I'd just like to echo your compliments to our statisticians, who did a stellar job this year in sorting out the distinguishing between the decline in value terms and volume terms. It was very difficult under circumstances with such strong swings in exchange rates, in commodity prices, and that was really it's an unusual circumstance. The other thing is, I'd just like to draw your attention to the services statistics, which, although they were down around 6.5%, this was much less than the decline in merchandise statistics. So that was a source of relative strength in trade. And so services tend to be less volatile than merchandise. And so that has helped to cushion overall trade in goods, in merchandise and services. And I'll leave it at that.
So we go back to questions now. Any other question we have here? Yes, John, and then.
Good morning. I was wondering if you could elaborate a little bit. What are your estimates on the cost to trade of the new normal of the global terror threat and the extra costs for companies doing business in terms of security, port security, airport security, facilities security, etc.? And if this would be eroding the potential benefits you're expecting from trade facilitation?
We don't see any indication in the data as yet that it is impacting trade, but conceivably it could if the situation became worse. If more border controls are imposed or additional security, it could slow the movement of goods across borders. But to date, we don't see direct evidence of that.
There are a number of studies out there that we could refer you to that give you estimates of the potential costs of border slowdowns. There's a lot of work that's looked at the time it takes to process goods across borders and turning those into tariff equivalents. I haven't seen anything that's updated this to our recent security environment globally, but it is something that we are aware of. We're not focused on it because it hasn't seemed to be a big issue yet. There is a regular ongoing work program we have here at the WTO on measuring and monitoring trade costs. If you look at last year's World Trade Report, where we estimated the potential effects, I think you were referring to that report, the potential effects of the Trade Facilitation Agreement. As we take that work forward, we hope to do this jointly with the World Bank, OECD, UNCTAD. This will clearly be an element that we will probably need to think about trying to measure.
So, Jamil, your question.
Sorry, again on Latin America, as you mentioned. Oh, yeah. That's the buzz one. Yes, on Latin America, again, when you mentioned that it's still perhaps low growth, can you specify Central America, South America, what are the numbers, what is the tendency you see? And still regarding the imports in Brazil, since we were talking on the technical questions, how much was the devaluation of the local currency a factor, or the recession? Can we try to measure this? How much was the recession itself? How much was the devaluation of the currency? Thank you.
As far as your first question about GDP growth in South and Central America, we have an aggregate figure for the region. Output declined 1% last year at measured at market exchange rates, compared to growth of 1% in 2014. And then this year we're expecting a even larger decline of 1.7%. That's for the whole region. As for the precise figure for Brazil, the IMF will be coming out with their forecasts next week. As for the impact of the recession in Brazil on its trade flows, it's very difficult to disentangle all of the components. Brazil's imports were down in volume terms, but its exports were up around 8% in volume terms. I can confirm the precise figures later. But So overall, trade probably contributed positively to the GDP growth in the country last year. Although, that's not necessarily a good thing. In an accounting sense, when imports contract, that's considered a positive for GDP growth. So it's not necessarily an indication of economic health. And overall, though, the situation seems to have been exacerbated by by the decline in commodity prices, but it wasn't a determining factor, I don't believe. Brazil's exchange rate, I don't know the precise decline, but it's, I know that the dollar appreciated around 20% globally in nominal effective terms. So prices of commodities in dollar terms worldwide fell across the board, whether it's agricultural products, fuels and mining products, or mining products or fuels. And Brazil would be affected by that. So, but in national currency terms, it was probably not as great.
Bryce, your question.
Thank you. Bryce Patrick with Bloomberg BNA. Appreciate your comments, gentlemen, right here. I didn't hear any mention of the digital economy in your report. Wondering to what extent did the digital economy or digital trade affect overall trade growth? And, are these figures incorporated in your report? Thank you.
I'll take a shot. Oh, sure. Well, so we do capture some of the digital trade that are recorded in, national income statistics and by other statistical agencies, but there is a broader economic debate and discussion around how well the traditional statistics are capturing the digital world. There is a joint initiative where our statistics unit, and Andreas Maurer, I don't see him here, but he's working with UNCTAD and UPU, I believe, to develop an initiative to do a better job capturing digital trade data. That's a project that we expect to go forward over the next couple of years. But we are largely dependent on the existing statistical systems to give us the data that we use. We recognize this discussion and debate around the digital economy. We expect its forces to be bigger in the future. Will countries trade electrons, ones and zeros, instead of products? Increasingly, we know a lot of services cross-border via the internet, but we don't have a very strong handle on that right now. Coleman, do you have anything to add?
Sure. We don't have anything on e-commerce per se in here, but we do, the decline in trade in IT products would be reflected in Chart 4 in the contribution of manufactured goods. In fact, office and telecom equipment was one of the larger contributors to the decline on the manufactured side. But it dipped quite sharply and then has started to rebound, just like other products.
The next question, please. So if there are, yes, go ahead.
Yes, I have one question. Have the WTO assessed the impact of oil price shocks on oil producer and oil consuming members? And for your point of view, what the impact of the price of oil have on the global trade? Thank you.
Sure.
So no, we haven't assessed the oil price impacts on either country's growth or on trade, although we have tried to break out price effects in terms of how that's captured in the trade data, in the value data, and as we translate that to quantity data. The IMF has done a lot of work on this. There's a monthly chief economist call among international organizations, and the IMF is, and the World Bank and Asia Development Bank and OECD and others who have greater capacity to analyze specific countries' economic evolution have spent time thinking about this. The biggest surprise, I think, that comes out of that discussion is the expectation that falling oil prices would have a much bigger impact on demand, positive impact on demand in oil-consuming countries than actually happened. So initially, when oil prices started to fall, we knew that there would be a negative impact on oil exporting countries. It would likely weaken their import demand. But the expectation was that consumers in oil-consuming countries would, their demand would be stimulated and that imports would likely go up. Instead, in many countries, it appears that that stimulative effect did not come through as large as had been seen in the past, that many consumers did other things with that money rather than buy goods. In many cases, they put it into savings or they deleveraged. They put some of that savings towards spending down private sector debt. So it really did catch many of us, many economists by surprise, and the IMF, I know, has done a lot of work on this. And I think if you look in the WEOs, you'll see some discussion about this. Coleman, did you have anything you wanted to add?
Just exactly what you said.
Jean-Pierre, your question?
Yes, the European imports in volume terms were up around 3%. I can confirm the figure afterwards, and also our imports I'm talking about. Exports are well, intra-exports were around 3% as well, and the extra exports were a little bit weaker. The volume figures are going to be on our online database shortly, but I can confirm them afterwards. But so exports to Asia were weaker and oil exporting regions, but intra-EU trade makes up the bulk of European Union trade. So trade between EU countries is around 3/4 of EU exports. Mm-hmm.
Next question, please. No more questions? Then Bob and Coleman, thanks very much for your input. Remember that, and thanks to all of you, by the way, and remember the embargo is lifted at 12 noon. Thanks very much.